Hello everyone, today's video is all about tax relief on property expenditure. So what can you claim against your tax bill for property lettings? Now, specifically, we're not talking about furnished holiday lettings. We're going to do a separate video on that because there are more generous tax relief afforded to you as a landlord if you have a so-called furnished holiday let, which basically is all about day counting, how many times you let it out in a year. It's all about short-term lets, the fact that it's not on long term and you get better tax breaks. But in this video, it's all about buy-to-let properties that don't qualify for furnished holiday lets. But like I said, it's a bit of a misnomer in the title because even though you may have furnishings in a regular buy-to-let, it still doesn't qualify as a so-called furnished holiday let. But let's not worry about that. So let's dive in, have a look at the expenses you can claim. You're a landlord, you've got a one or two or more portfolio of properties that you own, and these rules apply if you're an individual or if you're a corporate landlord. So you may have the properties investment company. The same rules apply in terms of the deduction for the various expenditure of the expenses that you incur in running that business. So first one, rent, rates, insurance, and ground rents. So that's pretty self-explanatory. All of that stuff you can get tax relief for. Next one, property repairs and maintenance. Now this is a biggie. It's probably the one that is largely the biggest expenditure category for many landlords, and I've done a separate video on this, but essentially it's the 3 R's. 3 R's, repair, replace, and renew. So if you are repairing something, replacing something, or renewing it, then you're going to get a revenue deduction, immediate tax relief. That's what we mean by a revenue deduction against your taxable profits of the year that you incurred those expenses. So that's always a biggie. Repairs and maintenance. Remember the 3 R's. Next on the list, legal, management, and other professional fees. So lawyers' fees, accountants' fees, estate agent fees. You may have someone who's managing the property for you, collecting the rents, letting agents, you're paying them a percentage of the income. Those fees are all tax deductible. However, within the guise of legal and professional, there are some exclusions that you need to watch out for, which you cannot claim a revenue deduction for. So, you can't claim tax relief on the first letting of this is on legal fees, legal and professional fees. You can't claim the relief on the first letting of a property for more than 1 year. So if you have an agreement and the agreement says that the tenant is going to be in there for more than a year, the costs of the professional fees you cannot claim for that particular expenditure. However, you can capitalize it, so it will go on the balance sheet and just be added to the cost of the property. Obviously, we know that the cost of the property itself, not tax deductible, sits on the balance sheet. So the first legal fees on the first letting of a property for greater than 1 year, not a revenue expenditure. Next one, which again, exceptions, so you cannot claim tax relief for the costs of agreeing and paying a premium on the renewal of a lease. So if you have a premium that you're paying on the renewal of a lease, the legals around that, again, you can't get an immediate tax relief. It has to be capitalized. What else can't you get immediate relief for in professional fees? Well, any fee paid for planning permission or the registration of title on a property purchase. So if you incurred fees to get planning or registering the title, they are not tax deductible on the P&L. But again, they will go on the balance sheet, they'll get capitalized. You will get relief for them when you sell the property. It'll reduce the tax that you pay on the capital gain. So, and of course, the legal fees associated with buying the property itself. The first time you buy, the first time the property becomes a part of your portfolio, the legal fees associated with that, that is again capitalized, goes to the balance sheet. Sourcing fees is another one. That is not a tax write-off in the year for the expenditure. It would go on the balance sheet to reduce any further capital gain. But your day-to-day professional fees, like I said, year on year, letting agents, accounting fees. Let's say you have to a lawyer to get involved to kick out a troublesome tenant, that sort of thing. That's all a revenue expense, and you get immediate tax write-off for that. So next on the list is, let me come over here, cost of services provided. So this is things like gardening or cleaning, so services you're providing to the tenants, for making it a better place for them to live in, the home that you own, the property that you own, the home that is there, it's their home, but your property that you own, services that you provide, including wages as well. If you have a decent enough sized portfolio and you actually employ members of staff to help you run your property business, that's where you recognize in the expenditure. These, by the way, are actual boxes on the self-assessment tax return in terms of grouping the classes of expenditure. So this is what it actually says on an income tax return, these different categories. So cost of services provided, cleaning, gardening, wages if you've got any staff to help you run your property business. Other allowable expenses, bit of a catch-all. So what can you put in what sort of examples are other expenses? Well, PPS, printing, postage, stationery, telephone costs for you having to be on, so not the phone bill of the property that you let, unless it's in your name and not the tenant's, but for making calls, dealing with all the stuff you have to do as a landlord, all the calls that you have to make, phone costs, business travel, mileage costs. So when you have to go and visit your property, we have to go meet with tradesmen or collect the rent, or all the trips that you make to either the property or the estate agents or to wherever it is that's connected with your residential portfolio business, you claim mileage relief. Bad debts. So assuming you're not recording your property income and expenses on a cash basis, you do it on the accruals basis, and if you had any bad debts, well, of course, you'd have income on the top line, but if you're never going to receive, if you haven't received that income, then you obviously, it's only fair that you're not going to be taxed on it because you haven't received it, so then you claim bad debt relief down here. This is where you put it in the other allowable expenses category. And of course, the biggie that's very important to landlords, particularly in the last few years, is the finance costs, so the mortgage cost. Now, you can only claim tax relief on the interest on a mortgage repayment, not the capital element. And as many people know, that was curtailed in itself. The interest bit was restricted about 5 years ago, and now in stages. Now it's fully excluded from calculating the profits of your tax of your property business. So you don't get relief for interest on the mortgages on your buy-to-let. Instead, what happens is that at the bottom half of your tax return, this is if you're an individual now, companies still get there's no interest relief restriction for companies, but assuming you're an individual landlord, then you may get a further credit against your income tax for some of the interest costs. And people say, well, it's restricted to 20%, but I'm a 40% taxpayer. So when I used to get 40%, I'm now getting 20%. But actually, you may not even get 20%, because depending on the makeup of your other income, depending on what else you've got going on, so you could be a landlord as well as being an employee, or have some investment income, or you've got your own company and you're paying yourself a lot of dividends. Depending on the makeup of your other income, other than your property profits, will determine how much finance costs you get tax deduction on. So it won't necessarily be the 20% rate. So I've done a separate video on that, and that explains, but in some cases, like depending on the makeup of your other income, you will get zero tax relief for all of the mortgage interest that you suffer. However, brought forward and carry forward. So thankfully what happens is let's say in a year that you are not allowed to claim any of the mortgage interest at all because you've got excessive amounts of dividend income from your own SME business or whatever, then on your tax return, you're allowed to carry that forward, unused, unrelieved finance costs, to next year. And next year, do the same calculation. Now, if next year your circumstances change and you no longer have as much dividend income, or the test has to be done each year, and it could be that the interest for that next year, together with the unused interest brought forward, you can then get tax relief the following year. So even though in a particular year you may be denied the interest relief, on the tax return it's noted, it's carried forward and brought forward the next year, because you can still maybe get relief for it the following year. So, finance costs. Next one, costs of replacing domestic items. Now, landlords who've been in the game a while will have heard of the wear and tear allowance, which was basically what this is brought in to replace. Wear and tear allowance, saying that basically 10% of your income you could claim as a tax deduction. That was phased out about 4 or 5 years ago, and they brought this new one in, cost of replacing domestic items, which says the first time you buy stuff in your buy-to-let property, like white goods or furnishings, carpets, utensils, the first time you buy any of that stuff, not tax deductible. Goes on the balance sheet, again, would reduce a capital gain. But of course, you may not sell the property for years, so you're not going to see the tax benefit. What most people obviously want is an immediate tax relief. You can't get it on the first expenditure on those items. However, when you come to replace them, then you get a revenue deduction. And the year after you replace any of these things, that's when you get tax relief. Now, again, I've done a separate video which talks about when you're buying a buy-to-let property, if you say to the seller of that property, look, let's just say this thing costs 200 grand. So rather than just have on the legals, I'm going to give you 200 grand for an empty house, you would say, actually, I'm going to give you 198 for the house and a couple of grand for all the furnishings. Then technically, that is your first acquisition of the furnishings, that 2 grand when you bought the property. So that when you come to renew them, which you would have done anyway, because let's say it's some old gear in there, so all of a sudden because you planned in your own mind to fit it out once you bought it with all the white goods and everything else, well, strictly that's a replacement at that stage. It's not your first expenditure, and then it would qualify. So neat little tip there for making sure that you get the replacement relief as early as possible. And then the final category for claiming expenses as a landlord is capital allowances. Now, capital allowances is basically tax jargon for depreciation of kit, depreciation of items, machinery, plant and machinery. So if you're a landlord, what sort of things would that mean? Well, it's for things like, let's say you've got an industrial carpet cleaner, or you've got a very expensive lawnmower. So the equipment that you need to run your property business is not the stuff that's in the house for your tenants. The stuff that they use is not the stuff that we're talking about, the white goods and the furniture. It's the stuff that you use, the equipment that you need to run your property business. That qualifies for these capital allowances. Now, capital allowances can be quite generous, and the write-off can be immediate, not necessarily over several years. So, you spend a few grand on an industrial carpet cleaner, you can get immediate tax write-off for that. So, capital allowances on items that you use in your property business. So, just an overview there on expenses that you can claim as a landlord, whether it be as a corporate landlord or as an individual. The big difference between the two, of course, is this finance cost. Whereas as an individual, like I said, it's not even taken account of in the profit. Your profit is inflated by the fact you can't get tax relief on interest as an individual, and then another part of your tax, so you pay tax at your highest rate on that, and then another part of your tax return, you may, if you're lucky, get relief at 20%. Now, of course, as a corporate landlord, there's none of that messing about at all. It just goes straight in as a deduction against your profits, and you pay corporation tax on whatever's left. So the fiddly bit is only applicable to individuals and not corporate landlords. So just an overview there then on property tax expenses that you can claim. If you like this video, and I hope you do, please do remember to subscribe, and I'll see you soon.